If you're considering hiring a financial advisor, don't make this critical mistake that could cost you a lot of money. Now, you might be thinking, I'm going to start talking trash about financial advisors. I'm not. I'm actually going to start talking a little bit of trash about bad clients. Because a bad client will try to pit financial advisors against each other to try to see who gets the best return and then just pick the winner. We've done that multiple times where someone comes to us with their portfolio and says, yeah, I've got like $500,000 with this advisor. I want to give $500,000 to you and just see how you do over the course of a year. It seems like a logical statement on the surface, but unbeknownst to you, the client, you're actually putting your advisor in a conflicted position because what they're going to be incentivized to do is to take higher risk in your portfolio in order to outperform the other advisor. And that comes in especially, that becomes a big issue, especially when the money they're giving, the money you're giving the financial advisor is maybe used for a different purpose than the money you have invested with the other advisor. For example, the other advisor, it's your RSP. The one you want to invest with the new advisor is your tax-free savings account. The RSP is specifically used for retirement, but the tax-free savings account, there might be the possibility that you might need to use some of that money in the next 5 years. So the new advisor rightly instructs you to invest in maybe an 80-20 portfolio, 80% equity, 20% fixed income. That portfolio has a much lower probability of outperforming a portfolio that's 100% equity. So if that advisor who recommends the 80-20 portfolio knows that they're competing against the other advisor who's in 100% equity, and you, the client, are only going to judge based off returns, which is completely illogical, by the way, they might be incentivized to take higher risk than they should on that portfolio, meaning they might seek out alternative lower grade bond yields, private debt on the 20% of fixed income. They might seek out higher risk speculative stocks or equity on the equity side. So just understand what you're doing when you're pitting advisors against each other to see who can get the best rate of return, especially over a short period of time. I understand it if you've been with an advisor for years and you're underperforming. That's a legitimate concern. If you pit advisors against each other, you're actually putting the advisors in a conflicted or a conflict of interest position to not do what's best for you, which might be lowering the risk of your portfolio. It might put them in a position to try to do what's best for them, increasing the risk of the portfolio to get the entire portfolio. Follow for more.